Welcome back, everybody, to the weekly market analysis for the week ending May 5th. Happy May, everybody. And we're going to take a look at the markets, take a look at some data, and talk about the Fed meeting that happened this week. But before we jump in, I want to remind you to hit the like button and subscribe to the channel if you're not already. You can also follow me on Twitter at Mr. J. Thomason, and you can subscribe to my free Substack at befinanciallyfree.substack.com. And you can find the links to those in the description below. So let's jump right in. First, just to kind of look at where markets are right now, we've got the S&P closing at about 4150 today, NASDAQ closing at just above 13,300. Not quite at a new closing high, but let's see here, very close, but not quite there. Dow closing at about 33,739. The Russell closing here at 1765. You can see there's what looks like a really close trend line break right there. We could talk about that in a little bit. The US dollar kind of just meandering around here at this low 101 level, between 101 and 102, where it's basically been stuck for a while, and still showing bearish tendency, but really not really having trouble breaking down below the current level that it's at right now. 10-year Treasury yield, you can see the red flag. That means that we have a bearish cross on the tide indicator for the first time since going back to 2021. We had a brief, if you see right here, we had a brief tide cross, which lasted all of about a month before going on to cross back bullish and then make new highs on the yield. You can go back all the way then to December 2018, right around the low of the markets, right around the time where Powell was about to make the famous pivot in the end of Q4 2018. That's the last time we got a bearish cross that actually went somewhere, and that took us all the way even into the COVID scare, where yields went down close to zero. So obviously that's a big development, but the yield closing at about 3.441%. We have gold, big down day today, although it recovered some of its losses. There was a point where it was down about $50 on the day, closing down 33.52 to 2016. And then we have crude oil, which has, after a kind of a flash crash yesterday, has recovered back up to about 71.34. Still looking pretty bearish, but we'll talk about that in just a little bit. And then Bitcoin, which obviously is trading, still trades 24/7. Bitcoin at 29,569. Kind of teetering between the 600s and the 700s throughout quite a bit of today. So what are the big market moving events this week? So at the start of the week, so let me pull up, I think it's KRE, I believe that's the regional bank ETF. The start of the week came with a little bit more drama relating to regional banks. And so you can see on the KRE chart, you've got back when Signature and Silicon Valley Bank collapsed. You see that the fall in the KRE right before that and around that time. And then you saw some stabilization. And then at the start of the week, you had another collapse in KRE because of the acquisition of, and I already, for some reason, First Republic, I believe, is the bank, the regional bank that it was. And then we had a couple of big drops on fears, especially yesterday. There were reports that a couple of other, like PacWest, were looking for buyers, looking for people to dig them out of the hole. And then today, just an enormous bounce in the regional banks. KRE up 6.29%. This is the largest. I think I was looking it up earlier. This is the largest gain in KRE since it's been a while. I don't even know if I can remember exactly where I saw that. KRE. Let me see if I can jump back and find this. it was years ago. I can't even remember. I tweeted about it, so you can find it on my Twitter feed. But it's been a while since we had a bounce at this level, or to this degree. Now, of course, when you're looking at the KRE and even since the collapse of Silicon Valley Bank, since the close of trading on Friday, March 10th, I mean, even you're still down 25% from that level. And then obviously when you go up to like before the banking crisis emerged, if you go to the local high, you're down over 41%. So obviously going up, a little over 6% when you've come down 40% is not that big of a deal. But obviously people who are jumping in on the shorts are getting squeezed like crazy today, or they, I guess, got squeezed like crazy today. So that's where we started the week. And then earlier this week we had the Fed meeting on Tuesday and Wednesday, and that led to a 25 basis point hike. And so let me do an hour chart. This might work pretty well. Let me turn off a couple of things. So yeah, if we go to May the 3rd, then you see that this hourly candle right in the center here, kind of towards the center of the screen. I'm going to try to blow it up a little bit. You obviously see the big price movement up and down, and then we ended up selling off. This is very interesting. And then today, or yesterday, we had some big moves on non-farm payrolls, on the unemployment jobless claims. And then obviously today we had non-farm payrolls. And what was interesting is the non-farm payrolls data actually appears to have been very hawkish. It shows a very strong labor market, and yet the markets did today the opposite of what they normally would do. But I'll get to that in just a moment. We had the 10-year also kind of bouncing around a little bit on some of the news this week. Let me go back to my daily chart and put the tide indicator back on. So on Wednesday, the FOMC, they hiked another 25 basis points, and that just goes right in step with what I've been saying. I got to turn this off again. With what I've been saying, if you've been following me on Twitter, about the 3-month Treasury yield, and you basically can just follow this and find where the Fed funds rate's going to go. So if you want to come up here and you want to put in the EFFR, which is the expected, or which is the Fed funds rate, and then USINTR, which is U.S. interest rate. So if you put both of those in, then what you actually see is, again, like I've talked about this a lot, it follows where the 3-month yield goes. And what I just want to call out right away, you can ignore the wicks. There's some odd trading that takes place, at least on this trading view chart. But what is really notable is that now the 3-month yield is at 5.271. So it's been closing now a couple of days in a row above where the upper bound of the Fed funds rate is. And the reason why that's concerning is every time it does that, without leveling off and stabilizing, that indicates that another hike is on the table. And I've been pretty vocal about this on Twitter. I wrote about it in my Substack, so you can check that out. But let me go back. If you go to, a lot of people have talked about a pause being very bullish, and I'm just going to summarize. You can go check out my newsletter for the full explanation here. But basically, a lot of people have talked about the Fed pausing, and that the pause is bullish. And there are a lot of reasons why I disagree with that. But there are a lot of reasons why I think it's too early to say that this is a pause. Now, I know that they changed the language in the press release, but basically that doesn't matter if the 3-month continues on the path that it's going. Because if you look here, in the end of 2018 and into 2019, by the time Powell made his little pivot, which was Friday, January 4th of 2019, the 3-month was still trading below the upper bound of the Fed funds rate and hadn't really moved, and it just kept going sideways and sideways. And other than, you see a couple of wicks, other than a couple of those wicks, it didn't do anything. It didn't, there was no there was no movement to the upside, no momentum to the upside. And so the Fed stayed paused all the way through the year. And then you actually see the 3-month trading down. And it's when the 3-month starts trading down that the Fed funds rate then starts following to the downside. And that's kind of what leads into the cutting of rates. And then you get to the repo crisis. And then obviously when the March COVID crash came, they fell down really low. So my point is that I'm going to be watching this, and I highly recommend you guys do as well, because this is an indication of kind of where policy is going. So I think that it's possible that one of the reasons why we're seeing a sell-off in the dollar and why we were seeing yields down was because, or on the FOMC news, is because we basically the market has decided, okay, this is peak, this is terminal rate, this is peak Fed funds. The Fed's done now; they're going to stop, and obviously we are even still pricing in cuts. And I don't have it up, but I've been trying to switch over my charts. I'm still using I still have the euro dollar up here, but we've kind of been shifting over, trying to use SOFR and some other things, but I'm still tinkering with which charts to use to get an accurate reading. But the euro dollar curve is showing at least 50 basis points of cuts, potentially even 75 basis points of cuts. If you go to the CME rate hike odds, which I don't have pulled up right now, by the end of the year, it is also pricing in. The highest percentage being priced in right now is that we're down at 4.25 to 4.5%, which is 75 basis points of cuts. So the market right now thinks that we're at peak terminal rate and that the Fed is going to be cutting before the end of the year, despite the fact that Powell said when he was directly asked about pausing and cutting, he directly said we're not cutting. And a lot of people have been trying to reinterpret what he's been saying as actually dovish and leaving the door open. He pretty much said, no, our plan is not to cut. And so I think that that's something to be aware of. And actually, if you go to a 1-minute chart, and the 1-minute chart for today is just insane. But if you actually go back to the rate decision, so you can actually see on the 1-minute chart here, you see the volatility from the moment that the statement is released, and then you get to 2:30 where the press conference begins. You get a dip and a rise and a dip and a rise, and then right at about the point that the market, and I was tweeting about this in real time, right about the point that he said, no, we're not cutting, that's when the market started to really go down and really didn't like that. And so that kind of set the course for where I thought things were going to go. But then, of course, you had Apple earnings on Thursday, and I jokingly tweeted on Thursday, like, oh, Apple is about to rescue the markets, right? And so let me pull up Apple. And Apple had, just like the other tech companies, Apple had pretty strong earnings, beating to the upside. Apple ended up trading up almost 5% today, which is right in line with where the options market had it trading up to. So yeah, that was I guess not unexpected, given the fact that earnings have been beating across the board. And that has been the story of 2023 now. In the first quarter, all of the earnings reports have showed a lot of strength, a lot of beats. And the reason why I think that this is bullish, or has been perceived as bullish, is because the expectations were, and I was seeing a couple of people online talking about this, the expectations were that the first half of 2023 was going to be awful, and that the second half was going to be a boom. And because the expectations were like that, I think this is why we're seeing all this strength, because we didn't see the torrential, awful, catastrophic crash that everyone was expecting first half of the year. I think everyone thinks that it's all in the clear, and nobody has a crystal ball. Nobody can tell the future. The future is always unknown. But there are a lot of things, in my opinion, that suggest, and I'm still standing by this, for as much as, Apple is making new yearly highs and about to take out its August 22 high, despite the fact that the Nasdaq is closing near its yearly highs, and despite the fact that Bitcoin is up close to 30,000. There are a lot of things that to me suggest a correction is in progress or happening. And honestly, think about this, you guys. If not for Microsoft earnings, and then Meta earnings, like if not for the big earnings beats that happened, which in my opinion, it's kind of lame. It's kind of stupid because the markets will boom because analysts will keep revising their estimates, and so the estimates get revised lower, and so then of course they always beat estimates. It never fails. They beat estimates like 90% of the time or so. Without those earnings reports and without Apple's earnings reports, it's hard to see this market being up. Like the Nasdaq is up, but the S&P, the S&P is not at its highs. And that's, again, Apple is a huge weighting in that stock. You could imagine what would happen if Apple wasn't up almost 5%. So that's something to notice, because the breadth of the market is not there. In fact, if you do SPY on a chart and then you compare RSP, I think I've shared this before with you guys, but if you put those up, then you actually are seeing underperformance from the equal weight ETF. And that just is, again, showing you that the impact of basically, well, I saw this meme, it was the S&P 5. Obviously, I think it's a couple more companies than that. But those are holding up the market. Otherwise, we're not at the level we're at. I mean, if we go off of, this correlation here, or this, divergence here, then the SPY ETF should actually be, let me actually do this right here. The SPY should be 5%, over 5% lower. So, that's something to consider. So I've been sharing for a while that I'm concerned about market breadth. There's another aspect that is affecting my decision or my thoughts, and that is the liquidity picture. It doesn't really matter like where you zoom. I know it adjusts. There are different ways that TradingView adjusts the chart. So like I could make it look like, oh, the S&P is supposed to trade fair value down to 39.50, or it could be, if I adjust a little bit more, let me see here. Oh, the S&P fair value is 40.20 or something like that. But in any case, the point is that there is a divergence between global liquidity and and Bitcoin and the S&P 500. And I still believe that this is going to come down. And it probably would have if not for the fact that we've had a couple of big moves to the upside in global liquidity. We had I think it was a $80 billion drain in the TGA this week. We had a couple $1 billion this week in the reverse repo facility come off or come out of the RRP. So that is liquidity into the market. So that has contributed to the up in liquidity, and but still, this divergence is not sustainable. You see that the numbers always come back to the blue line, or they always go. It's like a magnet to the blue line, and so I'm still expecting a correction. For all I know, like just understand that it could happen where the blue line actually ends up making its way up and kind of meeting the markets to the upside, but it could just as much be that the orange and white lines are going to come to the downside. So I would just be cautious about that. Another thing I want to point out here is what I did is I took 2 of the risk proxies, and I've been doing a study on this, and I'm still working on a little bit more of the history going back before 2012 and 2011. But basically what I've done is I've taken 2 of my risk proxies. So you've got in the top panel, you've got the SPX, which is the S&P 500. And then you've got in the middle panel, you've got the JNK cross versus the SHY Treasury bond ETF. And then in the bottom panel, you have the S&P high beta ETF versus the S&P low volatility ETF, and so high beta to low beta. And what I was doing was, and I've looked at this, the reason why these are the top two weightings in my risk proxy chart that I share in my newsletter is that typically the action in these two crosses is the most indicative of market declines. So what I've done is I've, in the top, kind of generated some boxes which kind of show you the areas where both the JNK-SHY cross and the high beta versus low beta cross were both bearish at the same time, or trending bearish at the same time, and they always coincide with these drawdowns in the S&P 500, which usually are at least about 10%. And that's really weird. I don't know what this one is doing here. It's kind of odd. And obviously, when I account for, this red box that I'm hovering over right now goes over a space where there was a little bit of green. But the gist was, even in this period of time in 2015 going into 2016, there were two dips of at least 10% in quick succession, the second one making a lower low. So that was a big deal. So again, I'm getting ready to look at data that goes back before 2011 and 2012. So hopefully that'll give me some opportunity to study a little bit more of these crosses. But I mean, if you go in recent history, the cross signaled these crosses going bearish or being bearish together signaled the 20% decline in Q4 of 2018. It signaled the crash in March 2020, and it signaled the bear market in 2022. So I've talked about this a lot. This crossed in early January. So the JNK-SHY crossed in December, crossed bearish, or I'm sorry, in November technically, and then the high beta versus low beta crossed bearish in early January. And we all know what happened. Stocks went down, 20%. So, and more in the NASDAQ and stuff. So I'm watching these, and the problem that I have is, let me go up to my normal charts so that I can show you in a bigger panel. The problem that I have right now is that, the way that this is going to cross bearish. I mean, unless high beta to low beta just rockets, this is going to have to come up from our close today. This is going to have to come up 4%, which is possible, but it's definitely against the trend. And if it doesn't come up, over 4% in the next week, it's going to cross. It's going to cross bearish, and that scares the bejeebies out of me, because if that goes bearish, then we potentially could be seeing 10%, a 10% correction, if not more. And like I said, 10% is about the minimum of the correction. So if you imagine that if we had a 10% correction from current level, from the current closing level, 10% down puts us at 3750 S&P, approximately so. And if we do 15, which there are a couple of instances of 15, if we do 15, that puts us close to S&P 3500. So again, not to scare you, I'm not telling you to go short the market, because these things can take time to develop. Nothing is, and nothing is foolproof. That's why I'm trying to do the study from before 2011 or 2012, because I want to get more. I want to look at more instances where this happened, or where these drawdowns happened, and also I want to be able to do a study on the timing of these corrections, and then how long it takes for them to bottom, and in what circumstances they bottom. So I'm trying to do all that research. Okay, so then we have today non-farm payrolls, and I'm going to pull this chart up, so what you see is I have my chart of non-farm payrolls data, and so I just have in the left panel, you can see that I have the establishment data, which the I think it was in March and in February. I think those numbers were revised downward, so a lot of people making a big deal out of that. But this month was higher, and so that's an improvement on the job front. Still, labor is very tight. And then the employed, and I've talked about this before, but I do a 6-month trailing average because the month-over-month change in this time series is really, really volatile. And so if we take the 6-month trailing average, this actually went up versus the previous reading. And that is pretty crazy, all things considered. That, again, that's the household data. We've had multiple months of increases lately, so that's something that is that I want to make sure everyone's attention is called to. We have the private sector hourly earnings in the right side panel, the first set of bars here. Private sector average hourly earnings have kicked up on a 3-month annualized basis. That's not a good sign. That acceleration on the rate of change basis is not a good sign for inflation. I actually suspect next Wednesday's CPI report is going to be a doozy. To put it simply. The one caveat here is that private sector average weekly hours ticked down, so down 2.3% on a 3-month annualized basis. So that's going to, so great if people are making more per hour, but if they're not working as many hours, then maybe it won't have as much of an adverse impact on inflation as potentially suspected. Definitely want to be aware of that. So that data came in today, and I was saying previously that the markets did something that they don't normally do. If you think about the last 16 months, and you think about what has typically happened when the markets, when we had a non-farm payrolls report that beat expectations. So when I say a beat, I mean the number came in higher than expectation on the payrolls. And then the unemployment rate came in lower than expected, and unemployment rate came in at I think 3.4%, so down from the last reading. And while we got an initial sell down on the news, it actually recovered pretty quickly, and then basically spent the whole rest of the day coming up. It looks even crazier on the Nasdaq. It was just huge gains, a little bit of a drop off, and then another round of upwards momentum. So that's what the non-farm payrolls did. I want to, let's see, what else did I want to do? I'm blanking now. Sorry about that. A couple of other things. I think I've already talked about the 3-month, the VIX. Talk about volatility getting crushed. Let me turn the daily chart back on. This has happened on a number of Fridays now. So we had a volatility crush last Friday, down 7.34%. Volatility was down 14.44% today. A couple of Fridays ago, down 4.15%. Let's see. The last trading day of the week going into Easter was down 3.67%. So we've just had a lot of volatility crush, and so I tweeted about this, and maybe this is where I want to leave you for now. It's kind of funny. We started the week talking about the crash of the banking system, contagion, bank risk. Everyone's blaring alarm sirens talking about how the Fed needs to cut. That everything is going to hell in a handbasket. We started the week like that, and it got kind of worse as we went. And then to think that now, I don't have it up anymore. I had Morningstar up earlier, and it shows the little bracket of. And I'll just pull it up. Why not? Take the time. I've already been recording for 29 minutes. If you go on Morningstar, it's hilarious, honestly. If I showed you, you can kind of see it right here in the center of the screen, but I'm going to pull up the larger version in just a second here. Tell me, if you saw, let me zoom it. Let's see if I can zoom it in here. It's not really working. Sorry. If you saw this and you didn't know what had been going on this week, you would not think that the beginning of the week started with banking panic. It's just crazy. I mean, look at small cap value. That's the regional banks that make up for that. Large cap growth, small cap growth, just rockets today. Everything, the whole thing, solid green. If you pull up, let's see, if I go to FinViz, they've got that cool S&P heat map. Let me see if I can get that up here. Again, like, look at, it's crazy. Like, on a day like today, you would not have expected that at the beginning of the week things were looking so hopeless. If you go down to, let's see, financial banks, regional banks, look at these numbers on the regional banks if you can see them on the screen. Plus 6%, plus 9%, plus 7%, plus 10%, plus 16%, plus 19%. Just, again, enormous gains in the financials. And then to bring it all back, one of the things I like to point out is look at how many times on the NASDAQ, 3 out of the last 4 weeks, price action late in the week helped to engulf an entire week or more of negative price action. So look here, today we almost, if the NASDAQ had finished up another, let me see here, if the NASDAQ had closed up another 3 points, only 3 points, it would have engulfed the entire negative week. And so it basically did. And then last week, Thursday and Friday, going from Wednesday, Thursday, Friday, we engulfed the entire month of April. Like I already talked about that. You saw, the second or third full week of April, I can't remember, right after Easter, you saw downside price action, and then Thursday and Friday engulfed it all back up. So 3 of the last 4 weeks of price action on the NASDAQ got engulfed in the last 2 days, in the last 2 trading days of each week. And in this case, just 1 trading day. And like I said, from last week, what was really remarkable was just 2 trading days led to April being a positive month. So just crazy stuff. And then I also wanted to point out, if I can find it really quick, I'll just pull this picture up for a second. My strength and volume scatter plot. This is crazy. When you see the relative volume down this low, we're talking all of these pumps came on low volume. This is complacency, and it's also it's very worrisome. So I would just be careful. I know I've been saying that the last couple of weeks, and I'm not trying to be bearish for the sake of being bearish, and I'm not trying to do doomsday things here, but I just want everybody to be aware that these are the kind of market conditions that concern me. And it might be, a lot of people I've been hearing say this, a lot of people are calling this a new bull market, and it may be so. But there's a lot of risks out there, and until, like I said, until the risk proxy picture turns out or looks better, and until the global liquidity picture looks better, I'm gonna be skeptical of the fact that the VIX is below, is down at low 17s. We can't have it every way that we want. Like gold, is gold gonna reach new all-time highs? Why are people buying into gold if everything is okay? Why are people, until today, why were people buying treasuries over the last couple of months if everything is okay? So these are just things to be aware of. Make sure that you manage your risk accordingly. And with that, I'm going to call it a day. I hope you guys have a wonderful day. I'll see you guys next time.